Welcome to today's market report.
Stocks surged globally on Friday in their best day in 5 months as strong U.S. corporate earnings reports fueled optimism about the economy, though 3-year high oil prices kept inflation risks alive and lifted government bond yields. U.S. investment bank Goldman Sachs Group was the latest on Wall Street to trounce market expectations when it reported a 66% surge in third-quarter profit, thanks to a record wave of investment banking activity. Though some analysts warned investors against complacency so early in the earnings season, especially given current constraints in the supply chain, U.S. stocks joined Friday's rally in global equities. The Dow Jones jumped 1.1%. In its best weekly performance since 25th of June, the S&P climbed 0.75% to notch its best week in 2.5 months, and the Nasdaq added 0.5%. The Pan-European Stock 600 index rose 0.74%, and MSCI's gauge of stocks across the globe gained 0.86%, the biggest daily rise since May 14th. We're clearly off to a good start of the third quarter earnings season, but have miles to go before we sleep, according to National Securities Corp. Only 35 of the S&P 500 companies have reported their earnings so far. Uncorrupted by news of a fatal stabbing of a British lawmaker on Friday, Britain's FTSE 100 climbed 0.37% to hit a near 20-month high. The UK blue chip index has now recovered all ground lost since the coronavirus pandemic began in March last year. Concerns that soaring oil prices could drag on businesses and the economy also took a backseat for now. Forecasts of an oil supply deficit over the next few months as demand rises on the back of relaxed travel restrictions drove oil prices to a 3-year high of above $85 per barrel. US crude recently jumped 1.13% to $82.23 per barrel. Brent added 0.83% to $84.70 per barrel after hitting a high of $85.1 per barrel. Bets that rising prices are likely to prompt central banks to raise interest rates sooner than expected lifted government bond yields, though gains were more pronounced in the United States than in Europe. The yield on 2-year US Treasuries, which reflect short-term rate expectations, zoomed up to a near 19-month high 0.3949% from Thursday's 0.3554%. Benchmark 10-year yield also rose to 1.5738% from Thursday's 1.519%. In Europe, 10-year bond yields slipped after registering 7 straight weeks of gains on signs of rising inflationary pressure and boost economic growth. The dollar, boosted by bets that a quickening inflation could prompt the Federal Reserve to raise interest rates sooner than expected, touched a 3-year high against the yen, which is usually sensitive to rate differentials. Gold prices took a breather on Friday after having their best day in 7 months the previous day. Spot gold dropped 1.6% to $1,766 per ounce. US gold futures fell 1.67% to $1,766.7 per ounce. The return of optimism will be tested by next week's anticipated weaker growth data from China and the impact of strengthening oil prices on consumers going into the winter month. The British pound has rallied on Friday to break above 137.50, reaching 137.75 for the first time since mid-September. The pair has appreciated about 0.65% in the best daily performance over the last few weeks and is set to close the week with a substantial advance after having appreciated nearly 2.5% so far in October. The sterling has extended its recovery from the second consecutive week, buoyed by a higher appetite for risk, which is hurting the safe haven dollar. The major stock indices are closing the week on a strong note, buoyed by better than expected quarterly earnings in the financial sector, which have eased fears about surging inflation and supply chain disruptions. Higher expectations the Bank of England might be the first of the world's major central banks to hike interest rates are also increasing demand for the GBP, with inflation accelerating at levels almost twice the bank's target for price stability. The euro keeps treading water on both sides of the 116 level, unable to take advantage of a weaker US dollar.
This is today's market news. Thanks for listening. We'll see you next time.